Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gold.com Inc. quarterly report. Gold.com Inc., a precious metals company, offers a diverse range of businesses and services through three primary segments: wholesale sales and ancillary services, direct-to-consumer, and secured lending. The wholesale sales and ancillary services segment provides various products such as gold, silver, platinum, and palladium in different forms, including bars, plates, powders, wafers, grains, ingots, and coins. This segment also offers complementary services like receiving, handling, inventorying, processing, packing, and shipping of precious metals. The direct-to-consumer segment caters to individual investors and collectors through its websites, offering a wide range of products including gold, silver, copper, platinum, and palladium. It operates various niche-targeted websites and markets its products on television, radio, the internet, and through customer service outreach. In addition to these two segments, Gold.com's secured lending segment originates and acquires commercial loans secured by bullion, numismatic coins, and graded sports cards. This segment serves financial institutions, bullion retailers, industrial manufacturers, sovereign mints, refiners, coin and metal dealers, investors, collectors, and e-commerce and retail customers across various regions worldwide. Overall, Gold.com's business encompasses a broad spectrum of precious metals-related services, making it a comprehensive player in the industry. The recent surge in gold prices has led many investors to speculate about the potential impact on mining companies, including those that were once publicly traded. However, one company's stock price is not among them: Goldcorp Inc. The reason for this is simple. Goldcorp was acquired by Newmont Mining Corporation in 2019, and its shares have been delisted from public exchanges ever since. As a result, there are no news events or developments that could have caused Goldcorp's stock price to skyrocket in the past year. Any changes in the company's fortunes would now be reflected in the performance of Newmont Corporation, which absorbed Goldcorp as part of its acquisition. The primary drivers of revenue growth and decline are multifaceted and influenced by various factors. On the growth side, an increase in gold and silver ounces sold, higher average selling prices for these precious metals, and strategic acquisitions have contributed significantly to revenue expansion. Additionally, a substantial rise in new customers, active customers, and total customers has also boosted revenue. Furthermore, a notable increase in direct-to-consumer average order value and higher gross profit margin percentages from acquired companies have further fueled growth. On the other hand, revenue decline is primarily driven by a decrease in interest income due to reduced interest earned from spot deferred trade orders and repurchase arrangements with customers. A significant drop in gold and silver ounces sold has also contributed to the decline. Moreover, an increase in interest expense has added to the downward trend. Other factors that can impact revenue growth or decline include commodity prices, hedging strategies, and foreign currency fluctuations. These external influences can have a substantial effect on revenue, making it essential for companies to closely monitor and adapt to these changes to maintain stability and growth. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2024 and 2025. In the 3 months ended December 31, 2025, net income increased by $7,554, 126.4%, to $13,528 from $5,974 in 2024. However, this trend reversed in the 6 months ended December 31, 2025, where net income decreased by $1,835, 12.8%, to $12,557 from $14,392 in 2024. Profit margins also experienced changes during this period. The gross profit margin decreased by 19 basis points to 1.442% from 1.632% in 2024 for the 3 months ended December 31, 2025. Conversely, the net income margin increased by 0.01% to 0.21% from 0.22% in 2024 during the same period. However, a different story unfolded when examining the 6 months ended December 31, 2025. The net income margin decreased by 0.14% to 0.12% from 0.26% in 2024. The gross profit margin for this period is not provided. The reasons behind these changes are multifaceted. Increased competition, market changes, and operational inefficiencies may have contributed to the decrease in net income and profit margins for wholesale sales and ancillary services. Additionally, higher selling, general and administrative expenses, depreciation and amortization expense, and decreased interest income also played a role in altering profit margins. Overall, the fluctuations in net income and profit margins between 2024 and 2025 suggest that the company is navigating a complex business environment with various challenges and opportunities. The company's financial performance indicates a positive trend in operating cash flow. The data from various pages of the report confirms this assertion. On page 2, it is stated that the company generated an operating cash flow of $1,341,667 as of December 31, 2025. Furthermore, on page 6, the 6 months ended December 31, 2025, saw a positive operating cash flow of $152,795. This indicates that the company's operations are generating sufficient funds to cover its expenses and investments during this period. Additionally, on page 80, it is reported that the 6 months ended December 31, 2025, resulted in an operating cash flow of $360.5 million. This substantial amount further reinforces the notion that the company is successfully generating positive operating cash flow. The company's financial performance reveals a notable increase in both interest expenses and debt levels. According to the data, interest expenses rose by $8.5 million, 41.8%, from 2024 to 2025, indicating a significant escalation in borrowing costs. This trend is further supported by the comparison of quarterly interest expenses, which show an increase from $1.7 million to $2.8 million over 6 months. The debt level also experienced a substantial rise, with the company's total debt increasing from $94 million to $120 million between June 30 and December 31, 2025. This increase in debt is reflected in the secured loans receivable, which grew by $26.3 million during the same period. These findings suggest that the company has taken on more debt, leading to higher interest expenses and a greater financial burden. Management is optimistic about the company's outlook and strategy. The company plans to continue expanding internationally, with a focus on entering the Canadian market. This expansion will be complemented by its existing strategy of tapping into the luxury precious metals market through various partnerships and joint ventures. In terms of operational efficiency, management has emphasized the importance of effective inventory management, which enables the company to make timely margin calls when necessary. Additionally, the company's equity method investments are expected to contribute positively to its outlook, reflecting a growing focus on long-term growth. To mitigate risks, the company employs hedging strategies and manages counterparty risk through strict credit and position limits with trading counterparties. Furthermore, management is confident in the company's liquidity, stating that it has sufficient funds to meet its needs for at least the next 12 months. Overall, these initiatives demonstrate a proactive approach to growth and risk management, positioning the company for continued success in the luxury precious metals market. The company has made several acquisitions that have contributed to its growth and expansion. One notable acquisition is the origination of loans secured by precious metal bullion and numismatic material owned by borrowers. This move allows the company to diversify its portfolio and tap into a new market. In terms of specific acquisitions, the company has taken on contingent consideration liabilities for LPM, Pinehurst, and AMS. Additionally, it has assumed stock payable liabilities for SGI. These transactions demonstrate the company's willingness to take calculated risks in pursuit of growth opportunities. On the other hand, the company has also engaged in divestitures through its share repurchase program. Under this program, 335,735 shares were repurchased for $9.8 million. Furthermore, a total of 1,321,003 shares have been repurchased to date, with 678,997 remaining authorized for purchase. The company has demonstrated a commitment to returning value to its shareholders through 2 key initiatives. Firstly, it has paid dividends, distributing a total of $9.8 million over the specified period. This payout was made in 2 installments, with $4.9 million being distributed on August 1 and December 2, 2025. In addition to dividend payments, the company has also engaged in share buybacks. A total of 1,321,003 shares were repurchased, with a total expenditure of $37.3 million. This strategic move allows the company to reduce its outstanding share count, potentially boosting earnings per share and increasing shareholder value. The company's financial reports reveal several red flags regarding its inventory management and supply chain. One of the primary concerns is the significant increase in inventory levels over a short period, indicating potential inventory buildup. The company's inventory increased by $248,301 from December 31, 2024 to December 31, 2025, and by $212.5 million from June 30, 2025 to December 31, 2025. Furthermore, the company's contract liabilities of $18.5 million as of December 31, 2025, suggest that there may be issues with supply chain disruption. This is also evident in the decrease in silver and gold ounces sold over the past year, which could indicate a mismatch between demand and supply. The company's inventory levels increased from $1,279.5 million to $1,535.7 million, indicating potential stockpiling of unsold products. Additionally, the company's liabilities on borrowed metals and product financing arrangements total $590,199 as of December 31, 2025, which could further exacerbate supply chain disruptions if not managed properly. These concerns suggest that the company may be facing issues with inventory buildup or supply chain disruption, which could have significant implications for its financial performance and overall operations. That concludes the financial summary for Gold.com Inc. Feel free to comment below, and I will be happy to answer them when possible.